You need to understand what just happened in the gold market, because this is one of those moments that only comes around once every few decades. Gold lease rates just went negative, and if you don't know what that means, let me be very clear. This is the kind of signal that precedes massive price moves, the kind that changes portfolios, the kind that separates people who saw it coming from people who wished they had. So what are gold lease rates? Think of them as the cost to borrow physical gold. Banks, bullion dealers, central banks, they lend gold to each other, and just like any loan, there's an interest rate. When that rate goes negative, it means lenders are literally paying borrowers to take their gold. Let that sink in. They're paying people to take physical metal off their hands. Now, why would anyone do that? Because they're desperate. Because the physical market is so tight, so constrained, that holding on to gold has become more expensive than lending it out at a loss. This is not normal. This is not how markets are supposed to function. And it's telling us something critical about what's happening beneath the surface. Let me take you back to the last time we saw this, 2008, right before Lehman Brothers collapsed. Gold lease rates went negative in the summer of 2008, and most people ignored it. They didn't understand what it meant. But the smart money? They were loading up. Because negative lease rates signal one thing above all else: a shortage of physical gold in the system. And when there's a shortage, and demand keeps rising, prices explode. Here's what's actually happening right now. The paper gold market, the futures, the ETFs, the derivatives, that market is massive. Trillions of dollars in notional value. But the physical market? That's tiny by comparison. And right now, there's a disconnect. People are waking up to the fact that paper promises aren't the same as metal in your hand. They're demanding delivery, and the system doesn't have enough physical gold to meet that demand. Look at what the COMEX is dealing with. Registered gold, that's the gold available for delivery, has been draining for months. We're talking about inventories at multi-year lows, and every time a futures contract comes up for delivery, there's this scramble. Dealers are borrowing gold, moving it between vaults, doing everything they can to make the numbers work. But it's getting harder, and negative lease rates are the symptom of that stress. Now, let's talk about who's driving this demand. Central banks. They've been net buyers of gold for over a decade now, but the pace has accelerated dramatically. In 2023, central banks bought over 1,000 tons of gold. That's the second highest annual total on record, and in 2024, they're on track to match or exceed that. China, Russia, India, Turkey, Poland, they're all accumulating. And they're not buying paper gold. They're taking physical delivery. Why? Because they see what's coming. The dollar's dominance is being challenged. Not tomorrow, not next week, but the cracks are forming. The BRICS nations are building alternative payment systems. They're settling trade in local currencies. They're reducing their dollar reserves. And gold is the one asset that every central bank trusts. It's the ultimate neutral reserve. No counterparty risk, no political strings, just metal. And here's the thing about central bank buying. It's relentless. They don't care about short-term price moves. They're not trying to time the market. They're accumulating for strategic reasons. And when you have that kind of steady, institutional demand hitting a market that's already tight, you get price pressure. You get shortages. You get negative lease rates. But it's not just central banks. Look at what's happening in Asia. Physical gold demand in China and India is off the charts. In China, gold withdrawals from the Shanghai Gold Exchange have been running at record levels. Chinese citizens are buying gold bars, gold jewelry, gold coins, anything they can get their hands on. Because they don't trust their property market anymore. They don't trust their stock market. They don't trust their currency. So they're moving into gold. And in India, it's the same story. Despite high prices, despite import duties, Indian consumers are buying gold at a pace that's stunning. Weddings, festivals, investment, gold is woven into the culture. But now there's an added urgency. People see inflation. They see currency instability. They see geopolitical tension. And they're protecting themselves. So you've got central banks buying. You've got Asian consumers buying. And now, you've got Western investors starting to wake up. For years, Western investors have been underweight gold. They've been chasing tech stocks, crypto, real estate, Anything but gold. But that's changing. ETF inflows are turning positive. Retail demand is picking up, and institutional investors are starting to add gold as a hedge. Here's where it gets really interesting. The mining supply side. Gold production has been essentially flat for years. We're not discovering major new deposits. The easy gold has been mined. What's left is deeper, lower grade, more expensive to extract. And even when new projects are approved, it takes 7 to 10 years to bring a mine into production. So supply is constrained, and it's not going to increase meaningfully anytime soon. Now, combine constrained supply with surging demand, and you get a squeeze. And that's exactly what negative lease rates are telling us. The market is squeezed. There's not enough physical gold to go around, and the people who need it, the banks, the dealers, the institutions, they're willing to pay a premium. They're willing to accept negative rates, because the alternative is worse. Let me paint you a picture of what this looks like on the ground. Imagine you're a bullion bank. You've sold gold futures contracts. You've made promises to deliver physical metal. But when the time comes, you don't have the gold. So you need to borrow it. You go to another bank, another dealer, a central bank, and you say, "I need gold. I'll pay you to lend it to me." But they say, "We don't have any to spare. In fact, we need gold ourselves." So you offer a higher rate, and they still say no. Eventually, you're offering negative rates. You're saying, "I'll pay you to take my dollars and give me your gold." And even then, it's hard to find. That's the reality right now, and it's not going to get better. Because the forces driving this are structural. They're not going away. Central banks aren't going to stop buying. Asian consumers aren't going to stop buying. And Western investors are just starting to buy. Meanwhile, supply is stuck, so the squeeze tightens. Now, let's talk about what this means for price. When lease rates go negative, it's a leading indicator. It tells you that the physical market is under stress. And historically, that stress resolves itself through higher prices. In 2008, after lease rates went negative, gold went from $800 to $1,900 over the next 3 years. That's a 137% gain. And that was in a period when most assets were getting crushed. But here's the thing. The setup today is even more extreme. In 2008, central banks were still net sellers of gold. Now they're aggressive buyers. In 2008, China's gold market was a fraction of what it is today. Now it's the largest in the world. In 2008, the dollar was still unquestioned. Now there are serious alternatives being built. So the forces driving gold higher are stronger, and the constraints on supply are tighter. What does that mean for you? If you're sitting on cash, if you're fully invested in stocks, if you're not paying attention to this, you're taking a risk. Because when this market moves, it moves fast. And by the time it's obvious to everyone, the easy gains are gone. The people who profit are the ones who see it coming, the ones who position themselves before the crowd. And here's the thing about gold. It's not just about making money. It's about protecting what you have. Because we're living in a world where currencies are being debased, where debt levels are unsustainable, where geopolitical tensions are rising. And in that world, gold is insurance. It's the asset that holds its value when everything else is in question. Now, if you're thinking about how to actually get exposure to gold, there are a few ways. You can buy physical coins or bars. You can buy mining stocks. You can buy ETFs. But here's something a lot of people don't realize. If you have a significant amount in retirement accounts, say $100,000 or more, you can actually hold physical gold inside those accounts through what's called a gold IRA. I put together a free guide that walks through exactly how that works, how to do it without triggering taxes or penalties, and what to watch out for. It's in the description if that's relevant to your situation. Worth checking out. But let's get back to the bigger picture, because what's happening with gold lease rates is part of a larger story. It's part of the breakdown of the post-1971 monetary system. When Nixon closed the gold window in 1971, he ushered in an era of pure fiat currency. Money backed by nothing but trust in governments. And for 50 years, that system worked. It had problems, it had crises, but it held together. But now, that trust is eroding. People see inflation. They see debt that can never be repaid. They see central banks printing money to solve every problem. And they're starting to question whether this system is sustainable. And when people lose faith in fiat currency, they turn to gold. It's happened throughout history. It's happening now. Look at what happened in Weimar, Germany. In the early 1920s, the government printed money to pay its debts. At first, people didn't worry. They thought it was temporary. But the printing continued, and the currency collapsed. People who held paper marks lost everything. People who held gold preserved their wealth. That's not ancient history. That's a lesson that's been repeated over and over. Or look at what happened in the 1970s. Inflation was raging. The dollar was losing value, and gold went from $35 an ounce to $850. That's a 24x gain in less than a decade. People who saw it coming made fortunes. People who didn't got crushed by inflation. Now, I'm not saying we're headed for Weimar-level hyperinflation, but I am saying that the conditions are in place for a significant repricing of gold. Because the fundamentals are there. The demand is there. The supply constraints are there. And now, with negative lease rates, we have confirmation that the physical market is under stress. Here's what most people don't understand about gold. They think it's just a commodity. They think it goes up and down based on supply and demand like copper or oil. But gold is different. Gold is money. It's been money for thousands of years, and when people lose faith in paper money, they return to gold. It's not a trade. It's not speculation. It's a fundamental shift in how people store value, and that shift is happening now. You can see it in the central bank buying. You can see it in the Asian demand. You can see it in the negative lease rates. The question is, are you going to see it before everyone else does? Or are you going to wait until it's on the front page of every newspaper? Because here's the reality. By the time gold is making headlines, by the time your neighbor is talking about it, by the time financial advisors are recommending it, the big move has already happened. The people who profit are the ones who act when the signal is clear, but the crowd hasn't noticed yet. And right now, the signal is flashing red. Negative lease rates are not normal. They're a distortion. They're a sign that something is broken in the market. And when markets break, they reset. They find a new equilibrium. And in the case of gold, that new equilibrium is going to be at a much higher price. Think about what has to happen for lease rates to go positive again. Either demand has to fall, or supply has to increase. But demand isn't falling. Central banks aren't going to stop buying. Asian consumers aren't going to stop buying. And Western investors are just getting started. So demand is going to stay strong, which means supply has to increase. But how? Mining production is flat. Scrap supply is limited. The only way to bring more gold into the market is through higher prices. Prices high enough to incentivize people to sell. Prices high enough to make marginal projects economic. Prices high enough to balance the market. And here's the kicker. Even if prices go significantly higher, it's not clear that supply will respond quickly. Because gold isn't like other commodities. People don't sell their gold just because the price goes up. They hold it. They pass it down to their children. They view it as wealth, not as a trading vehicle. So even at higher prices, supply might stay tight, which means prices could go much higher than most people expect. Now, let's talk about the paper market, because that's where the real risk is. The COMEX, the LBMA, the various gold derivatives markets, they're all based on the assumption that most contracts will be settled in cash, not physical metal. And that works fine as long as everyone plays along. But what happens when people start demanding delivery? What happens when the physical market can't meet the demand? We've already seen glimpses of this. In March 2020, during the COVID panic, there was a brief moment when the futures price and the physical price diverged. People were paying premiums of $50 to $100 per ounce over the spot price just to get physical metal. Dealers were sold out. Mints couldn't keep up with demand, and the paper market was in chaos. That was a warning shot. It showed that the paper market is fragile. It showed that when people want physical metal, the system can't deliver. And negative lease rates are telling us that we're heading into another one of those moments. Maybe bigger. Maybe longer lasting. So what do? First, you educate yourself. You understand what's happening. You don't just take my word for it. You look at the data. You look at central bank buying. You look at COMEX inventories. You look at lease rates. You look at the fundamentals. And you make your own decision. Second, you position yourself. If you believe that gold is going higher, you need exposure. Whether that's physical metal, mining stocks, ETFs, or a gold IRA, you need to have skin in the game. Because sitting on the sidelines means you're betting against thousands of years of history. You're betting that this time is different, and it never is. Third, you stay patient. Gold doesn't move in a straight line. There will be pullbacks. There will be volatility. But the long-term trend is clear. And if you're positioned correctly, you'll benefit from that trend. Here's the bottom line. Negative gold lease rates are a big deal. They're a signal that the physical market is under stress. They're a precursor to higher prices. And they're happening at a time when the fundamentals for gold have never been stronger. Central banks are buying. Asian demand is surging. Western investors are waking up. Supply is constrained. And the monetary system is under pressure. This is not a drill. This is not hype. This is a structural shift in the gold market. And the people who recognize it, who understand it, who act on it, they're going to be the ones who preserve and grow their wealth in the years ahead. The people who ignore it are going to look back and wish they had paid attention. So pay attention. Do your research. Make your decision. But don't wait too long. Because markets move faster than most people realize. And by the time it's obvious, it's too late.